Let's take a look at Forex. Forex is, of course, short for foreign exchange and is actually one of the largest markets in the world. Many reasons for that. One is because of trade. One company, when it does business with another company in another country, there has to be some foreign exchange involved. So trade by itself puts a great demand on foreign exchange. Not only that, the foreign exchange market is also full of speculators and traders who want to make quick profits or perhaps a short or medium term profits. The forex traders are the largest community in the world of all traders. And so all put together, foreign exchange is the largest asset class or the largest market in the world. On a daily basis, some $4 or $5 trillion worth of foreign exchange is traded in mostly Tokyo, London, and New York. These are the three main centers in the world. Now, Forex is traded in pairs, as you can imagine. So if you want to buy USD, then you have to sell something. If you want to convert your USD to Euro, then you'll have to sell your USD and buy Euro. Similarly, for all the other currencies as well. There are about 8 or 10 major currencies which are traded freely in the Forex market. Currencies go up, they become stronger, and sometimes they become weaker. And there's a lot of factors involved as to why currencies become weaker or stronger. It has to do with the state of the economy. It has to do with prevailing interest rates in that country. It has to do with sovereign risk, geopolitical risks, all kinds of stuff. So foreign exchange is a hard asset class to really wrap your mind around because it dances to too many tunes. In general, if you're trading foreign exchange, you would be mostly a short-term to medium-term trader. Unless you're a professional, I don't know if you would take up long-term positions in Forex. And there are many reasons for that. One of the reasons is in the Forex market, the Forex market has a lot of leverage, which is margin. So I know we're going to cover all those concepts in the next section, but it uses a lot of leverage, and therefore small moves can show up as big gains or big losses. There's a lot of things to the Forex market. It's complicated. And so most beginners to financial markets will put Forex really on the back burner and look at all the other stuff first. In the currency market, there are 2 or 3 currencies that are considered to be safe haven currencies. One is the US dollar, the other is the Japanese yen, and the third is the Swiss franc. Traditionally, these currencies have been considered to be safe havens, and the Australian dollar and the Canadian dollar are heavily influenced by commodities because both those countries are major commodity exporters, and therefore their currency is heavily influenced by the prices of commodities. And so now in Jan 2016 and Feb 2016, the prices of commodities have crashed, and so both the AUD and the CAD, the Australian dollar and the Canadian dollar, are generally going to be weak compared to all the other currencies. Now, the Chinese yuan is fast becoming a major currency. The IMF wants to include the Chinese yuan in their special basket that they have. Right now, it's all the other major currencies, but I believe the IMF is going to add the Chinese yuan also into that basket, along with all the USD, Japanese yen, euro, Canadian dollar, Swiss franc, and all of that. In general, if a country has high interest rates, so if a country is offering high interest rates, then money tends to come there because, as you can imagine, institutional investors are looking for even the smallest of gain from their current situations because these people have hundreds, 200s, perhaps even $100 billion to invest. And so even a 0.25% change in interest rate will produce a huge number for these institutional investors. And so if a country is offering high interest rates, money generally tends to come into that country. And conversely, if a country has zero interest rates or negative interest rates, then money tends to flow out of that country. So that's just a general rule of thumb. Of course, there are safe haven factors like the Japanese yen. It's in negative territory now in terms of interest rates. However, it's also a safe haven. So things will be a little different there. If the UK raised interest rates to 3% or 4%, people would be piling into the British pound because they would want to capture that good interest rate because the UK is a AAA country. It's well rated in the credit markets. And so investors would feel very comfortable putting their fixed income money there and taking advantage of the higher interest rates. Anyway, so this is just an intro to Forex. Forex is a huge, huge affair. And so we're going to take a look at all the details in the section on Forex. Thank you.